Well, I think we are at 11 o'clock. So welcome to everybody. Hope you had a good, well, a couple of weeks really, because obviously we didn't do one last Friday because it was a Good Friday. Various things been going on. Let's switch this one. Okay, so hang on a minute. Just jumping around. News this week. I thought I'd start off with Gresham House Fund, because actually we've got Tony Dorwood with us later on. He can talk a bit more about his battery fund. But Grid has just announced that it's invested in a 15 megawatt project in Suffolk, which takes the total portfolio up to I think 274 megawatts. And we see quite a lot of potential for this going forward. I've been doing some work on some of the renewable energy funds that we've got, so there'll be notes out shortly. And one of the things that the government is quite keen on, and one of the reasons is reintroduce subsidies on onshore wind and solar, or proposing to, is to massively ramp up the renewable energy production. But the only way that's going to work is if there's a lot more battery storage alongside all of these projects, because obviously the output is quite variable, and it needs something to smooth it out, just to maintain the frequency on the national grid, which is part of the thing, to manage shortfalls, the whole capacity mechanism thing. And also there's an opportunity to make a bit more money by trading the power price through the day. So those are all ways that the Gresham House Battery Storage Fund, Gresham House Energy Storage, can actually make money. So this new one in Suffolk, which was part of the original portfolio that they said they were going to buy at the IPO, was actually developed by part of Gresham House. That's now in the portfolio, so that's good. The other, another big story of the week has been a sort of drip of news from property companies about mainly about who's paying the rent or not. So one end of the spectrum, you've got a fund like Triple Point, where, as we've been saying for ages, these things are fairly cast iron. It collected 98% of all the rent that was due, because the local authorities are not going to default, and the extra 2% will just come in the next couple of weeks. It might be there already. But of course, if you're exposed to companies as serious as in Germany, it's a much tougher prospect. Serious, now 75% of rents collected. That's not as bad as it looks, because actually it expects some of the rent to come in late anyway. Just the way things fall, and it's saying that the German government's plan to try and prop up the Mittelstand, the small companies sector, seems to be working. But I've read elsewhere that it's got the same problems that we have in the UK, and it's been sort of swamped by applications. Not as bad as in the US. Apparently, the US has actually run out of money. Picton, the figure was 71%, and they decided to suspend their dividend. UNI, which is much more about developing new properties, same thing, they've suspended their dividends. The number's only 51%. And obviously, they're not on site in a lot of their planned developments now, which is going to hold them back. And then you've got BMO Commercial Property, which was, I always thought was a good investment, because it was unloved because it was retail, but actually its retail was in the West End and St Christopher's Place. It's not particularly highly leveraged, but in terms of the rent collection, it's saying that it expects problems with St Christopher's Place and then all the rest of it, the other retail properties. And it's got a £50 million loan from Barclays that has got a covenant on it, and it thinks that actually might be looking dodgy. But so it's talking to Barclays already, and it says they're sympathetic to the situation. And this comes back to with all these property companies. Yeah, if and when we get problems with covenants, what the bank's going to do? The banks ought to be lenient, given what the government's saying, but we'll wait and see. Actually, BMO should be okay anyway. It's got a fair bit of cash, and it's got another facility with LNG, which you can draw down on, and which I think is more or less enough to pay off that Barclays loan if it had to. That actually falls due for repayment in 2021, so it's relatively short term. If you can refinance it, then that might be a bit of good news. It's not all doom and gloom in the property sector. I thought it was quite interesting. We saw a story, I think it was yesterday, it might be this morning. Healy Court Bars sold an office block in Farringdon, just by St Bart's Hospital, on a yield of 3.92%, which is quite impressive. It just shows the demand for this stuff. And obviously, 3.92 sounds ridiculously low, but if you can finance it a lot cheaper than that, which you definitely can now, then it's still going to make you money. Talking about banks still, Banksy and European Financial, which basically specialises in investing in the sort of weird and wonderful bits of banks' capital that they've had to create to cope with the new Basel II requirements and that sort of thing. It thinks that banks are in a relatively good place. This is basically reinforcing the story that the Powder Cap Financials has been saying, that actually banks have been shoring up their capital base for a long time, ever since the financial crisis, and they haven't done a lot of the dodgy lending that's been going on past decade. We had results. I mean, the results analysis is coming out, and obviously the problem with the results analysis is they sort of relate to the period just before all this started. And so actually some of these funds had great years. So Martin Curry Portfolio, which is I think it's the first full year under Zerid Osmani, the new manager, actually did very well. And Mercantile had a great year last year as well. Contrasting fortunes in 2020 though, the Martin Curry portfolio seems to be holding up very well, and actually the discount popped out for a bit, but it's come rattling back down again because it's got a zero discount control policy, and that seems to be working. And so that's in the good camp. Mercantile though is one of these funds that it's trading at asset value, which is good, but the actual underlying assets are still, I think, roughly 30% down on the year. So not looking too clever. And that's basically UK PLC. Definitely international investors like juries out on UK equities at the moment still. Harking back to what we were talking about last time with CLOs, Alcentra, which invests directly in loans, it doesn't invest through CLOs, and it's actually sort of also winding up. But nevertheless, in a statement that he released this week, it says that new CLO issuance has stopped. And what that means in practice is that there is now no more demand for loans. So if companies that have been used to financing themselves this way are now going to have to look elsewhere for finance, which might mean they're going to have to come cap in hand for the banks, and which might mean they have to pay more money, or they might just find that they can't get the finance at all. And so that's going to be a big issue for the next few weeks, definitely. Augmentum, FinTech, bit of good news for them. And they've already said with their portfolio that they thought that a lot of companies were actually not particularly affected by COVID and would be able to get through this, and some of them actually sort of benefiting. It saw new outside investment into two of these this week, so Onfido and Previs, both of which I think do something around security, so like sort of thumbprint recognition and that sort of stuff. I mean, it's a mixture. They do different things, and actually, I think our news story has a bit more information on that if you want to have a look. But it's encouraging that there is still finance available for these stuff. And obviously, although we're not talking about the same pot of money, but the private equity industry is sitting on a huge amount of money still, and it should be casting its knife all over things. We'll wait and see what happens. we talked a bit about DPA last time. Medio made an announcement this week. So Emirates has asked it to come to some kind of arrangement because obviously its fleet's grounded, and if it can avoid paying its lease rentals, it would like to. It hasn't stopped paying the lease payments, so Medio's not in trouble. But basically, it's a sort of tripartite thing now that Medio's got to talk to its banks and see if it can persuade them to suspend interest payments for a bit, or the amortization payments for the debt as well. And if it can do that, then it will be able to give some kind of forgiveness to Emirates at the same time. So it'll be a sort of three-way thing. And last on the list, but probably sort of most interesting for many people, Target Healthcare came out with a statement this week as well, because there's always been a lot of stories about COVID in care homes. It reckoned it's had cases in, I think, 5% of homes. So it's got 70 odd homes with spread across, I think, 27 different care providers. So that actually, it sounds like it's got a fairly good record, considering what the numbers were being bandied about in the press with this stuff. It actually tried to lock down these things early, which is good. There's an issue for the care operators that rent the homes in that they're having to pay a lot more for staff where they're shipping on a temporary basis, which is understandable. But actually, it's not worried yet that the care operators won't be able to pay their rents. So Target seems to be in a good position. And because we didn't talk about it last week, I just thought I'd mention perpetual income growth. Obviously, Mark Barnett's being fired, and I think we've now got until, if anybody's listening who's got an asset management company, you've got until 5 o'clock today to put your application in to run this fund. I made the point last week, and I think I'd reinforce it now. I'd quite like this to end up as a merger with one of the existing funds. There seems to me to be too many UK equity income funds around, and then definitely too many small ones. If this one's a decent size, you probably have to offer a cash exit, but if you've got an attractive enough proposition and a decent enough record and a tight enough discount, and actually most of these things are now trading asset value because people have recognised that it's a lot better idea to have UK equity income through a trust than through an open-ended fund in this environment. Then it makes sense to me to do it as a merger or takeover. So reverse takeover maybe for a smaller fund. But we'll see what happens. I'm not holding my breath on that. So that's the news. And as always, if you want to ask questions, you can do so. And basically email me, jc@martinandco.com, or message me through the app, either through the chat function or by raising your hand. But I won't do the questions now. What we're going to do first is talk to Tony Dorwood from Gresham House. He very kindly agreed to come on and be our first guinea pig for one of these things. So I'm going to just unmute his line now. That works. Hi, Tony.
Good morning.
So I think the trigger for getting you on here was the fact that we've seen you win a mandate for a Strategic Equity Capital, which is one of our clients. So we're obviously keen to catch up and thought people might be interested to know what the driver was for that, how it came about, and what you plan to do with it. I know it sits within your Strategic Public Equity Group. Maybe you could tell us a bit about how this works in practice.
Yeah, thanks for the invitation. Good to be here. I hope everybody's well and staying well. Just to let you know, Gresham House is a quoted alternative asset manager, and we've got a number of investment trusts or investment companies within the umbrella of Gresham House. You may know others like Gresham House Strategic, the two Baronsby Venture Capital Trusts, a couple of renewable VCTs as well, and then the energy storage funds, which you mentioned earlier, Grid. So there's quite a few that we can talk about. But when it comes to SEC, the big picture there is that there is an ambition to grow the strategic public equity platform. And just to remind people that are listening what that is a private equity approach to investing in quoted companies. What does that mean? It means looking at the companies through the valuation lens, the engagement lens, and the strategic lens of a private equity house when and before making an investment, and then subsequently making the investments, to monitoring and engaging with the companies. This is a something that it's not a very well diverse number of people doing this. SEC is probably one of the largest, not the largest, official strategic public equity investment trust that exists. So we're delighted that it's coming into the Gresham House family. It is an area which I've been involved with personally for nearly 20 years now, having set up that way of doing things at Schroeder Ventures back in 2002, where we launched 2 limited partnerships, as well as in 2005, the SEC back in those days. So there is a bit of a circularity here. We already have a platform in SPE within Gresham House when we took over Spark Ventures 5 years ago and turned it into Gresham House Strategic GHS. That's had a good record since that date. And therefore, when the opportunity for the SEC became a real one, and the process that the board there went through, which was extremely thorough and quite lengthy in time, we were really, really pleased that they gave us, and within the joint venture we have, which we'll talk about in a second with Aberdeen, the opportunity to bring it into the Gresham House fold, and then have a medium to long-term ambition to grow this area accordingly. So in summary, we hope in May the official transition date will be concluded. Then we will, dependent on the virus situation, be able to start getting together, but we're already having regular communications between us and the existing manager in order for that transition to happen. So long story short, we're looking to grow the strategic public equity platform considerably, and as part of that, the Aberdeen standard marketing and distribution machine is there to support that.
Cool. So I suppose some people might say, well, given you've got 2 funds doing the same thing now, why don't you just knock them together? But they are different, aren't they? Yeah,
they are different. I mean, the headlines are very similar. The investment philosophy is very similar, which is great, because what one is that we can bring the intellectual property of both Jeff and Adam, who are current managers on SEC, within the umbrella of Gresham House. And they should fit in well in the dialogue and working together with the likes of Richard Staveley, Ken Watson, and others within the investment team, and myself as well. So that's an important point, because the culture is critical on the sustainability of a business. But if you look at the 2 portfolios today, they are clearly different. The median or so market cap of the SEC is circa 300 million sterling, and that the difference between that and GHS is considerable. So GHS, with the median market cap, will be below 100 million. There is a highly focused nature to the GHS portfolio, where you can see over time where we have got heavily engaged in businesses owned between 5 and 25% of a company, and willing to have 10-15% of the portfolio in those companies where we have that high conviction, with engagement such as putting people on the board, engaging with them in investor relations and strategic decision making, things that may lead to companies delisting, taking private, or indeed having some private instruments in there, like convertible loans. With Northbridge is an example of that within the GHS portfolio. So there are clearly differences between the SEC, both size, some of the instruments in there, and the portfolio construction.
So the aim is to grow both of these things then, isn't it, really?
Yeah, so in due course, the ambition is to grow the whole platform, make decisions at the right time as to how to grow that, whether a further limited partnership, whether to expand if we can get the discount in on either or both of these trusts so that they can be grown again. I mean, before the COVID situation arose, a couple of months before that, the GHS portfolio or trust had got down to a 3% or so discount to NAV, having gone from 40-odd% when we took it over discount. And similarly, in history, SEC has been has issued shares at different points in time. We launched it in 2005. It actually raised new shares subsequent to that, 1 or 2 years later, and then it also raised shares back in the sort of mid 2010s. So there are times and periods where this is the great opportunity. Unfortunately, the great opportunities like there is now with some of the valuation dislocations, you also are consistent with discounts on the N8 to NAV, which doesn't allow you to grow potentially at the right point in time to make good investments.
Yeah, it's always a great shame with this. In terms of going forward and expanding the funds, one of the things that should help quite a lot is this tie-up that you're going to do with Aberdeen Standard Investments. So this is something you announced last year, but it's not quite done and dusted yet, is it?
No, it is done and dusted. The legal frameworks, regulatory frameworks are all in place, just waiting for regulatory FCA sign-offs, which we think are imminent. And the ambition there is quite simple. There is a large machine in investment trusts and distribution within Aberdeen. And we want to tap into that in order to expand the SPE platform and portfolio. So, summary: Aberdeen, its capability in marketing and distribution is something that we want to bring to the table and exploit over the short and medium term to grow this whole area. And that is one of the things which the SEC board, as well as the GHS board, were very keen on as we got into bed with Aberdeen.
Cool. Okay. Good. So just on the rest of the business then, so I've already talked a bit about Grid. What do you see the potential is for that fund in terms of expanding it? Because it's getting to, been spending quite a lot of money recently.
Yeah, so the dynamics of batteries, if you're unfamiliar, as such that they are needed in order to manage the fluctuations in the grid. As more and more renewables come on the system, we're now at 30+% renewable energy on average throughout the national grid system for power generation, which 10, 15 years ago was practically zero. And as you look forward, that number is going to grow from 30 to a much higher number. So the ability to manage the grid becomes far more complex and technical. And as fossil fuel disappears, then you need the ability, sun doesn't always shine, wind doesn't always blow. So you need to be able to manage the grid during those periods of time when there is either excess supply from wind and solar or undersupply. That's the principle of what batteries are all about. They are being used for in other countries to a even greater extent than we do in the UK. It is increasingly recognised by the national grid the role they play in being able to manage the grid system. So there's the macro tailwinds, so to speak. But in order to do this, we need to deploy, install, energize the batteries, and that takes time. And that's what Grid is all about. It's taking these energized and established battery platforms that we are developing outside of Grid. And then they're being bought by Grid, the vehicle Grid, and then they're being run accordingly. The primary focus of our batteries within the Energy Storage Fund, Grid, is that they're looking to exploit the pricing differentials that happen as a result of these fluctuations. They do have other revenue streams, but that is the primary focus of the revenue streams.
Cool. Okay. Good. And the other thing that you've done relatively recently, you took in the management company for residential secure income.
Yeah. So within Gresham House, if you have a look, there's a lot of information on the website for Gresham House. It is, as I say, a quoted asset management business. Within it, we have a division that's real assets division, and we have a strategic equity division. In the real assets division, we have forestry, renewables or new energy, and what we call housing and infrastructure. And the housing and infrastructure has recently acquired a long-established business called Trade Risks, which manages Resi PLC. And Resi PLC focuses on social housing, retirement housing, and all sorts of different secure income revenue assets within the housing space. We intend growing that business, both the PLC. The ambition is to get that back to NAV. We've identified routes in order to pull levers to increase or work out how we can reduce that NAV, and over the medium term start growing that PLC. In addition to that, there are private vehicles which are on the runway as well, within things like shared ownership housing, which this team has a lot of experience in. And this comes out of our housing and infrastructure platform, which again is a limited partnership platform under the brand of British Strategic Investment Fund. So all in all, we want to grow the Resi PLC, by pulling some levers, including investor relations, public relations, and getting the dividend covered within the Resi PLC to pull those levers, get the vehicle back to NAV, and ultimately grow it. So we're quite excited about that. The current macro situation is going to probably extend the timetable to achieve all those ambitions, but we are very excited about that team, the capability in that team, and the vehicles that already exist.
Cool.
If you come across to forestry, there are no quoted vehicles that we manage within forestry. They're all limited partnerships or segregated managed accounts. There has been examples in the past of having quoted forestry. Each have their own specific issues. This is a very long-term asset class. As a result of that, income yields are not always predictable, because there may be times where you don't want to harvest trees and then send the cash back in dividends because of pricing of timber, and that's led to those previous examples of forestry investment trusts not always trading or anywhere near it trading at NAV, and they've had their own specific issues. So at the moment, there's no plans for a listed version of the forestry business that we have, but we are a very sizable business in that area in private limited partnerships and managed accounts.
Cool. Okay. And you've got quite a few different funds now, so it's becoming quite an important player in the whole investment trust arena.
Yeah, I think we've got about 7 actually. I mean, on our other division, the strategic equity, we run obviously the Baronsmead VCTs, where there are 2 of them. I think number 2 or number 3 market share there. And then we have within our equities unit, we have Ken Watton, who's been around quite a while. He's got a 10-year open-ended microcap fund and just around a 3-year income fund, open-ended, which I think is number 1 since inception, which he's doing very well on. And then, of course, we have the GHS Strategic Public Equity, managed by myself, Richard Stavely, and Laurie Hull. So that's very much a team effort going into that one as well. So yes, we're quite pleased that over the last 5 years, since the management buy-in of Gresham House 5 years ago, the team that's built quite a platform, and one that over the long term should grow with the structural growth within this asset allocation to alternatives. So yeah, we're very optimistic. I mean, notwithstanding the slowdown that's happening at the moment and how long that may last, we know that structurally alternatives will continue to grow. And also the fact that demand for income yield is increasingly relevant to investors.
Yeah, cool. Thanks very much for that. Very helpful. So I suppose now we'll turn it over to the listeners and see if we've got any questions. So again, if you've got any question, email me directly on jc@martinandco.com, or ask questions through the chat function, or raise your hand on the Ring Central thing. So, got one straight away. Just on the type with Aberdeen, actually, why was it that that just covered the strategic public equity part? Why didn't it apply to the rest of the business?
Yeah, it's a very good question. Aberdeen have, over the last 2 or 3 years, if you have a look at what they've done and how they set their stall out, they've increasingly grown their private asset side. They also recognise that the cultural differences between private and public assets is significant. Therefore, one has to tread carefully when you do M&A or partnerships, etc. So they know that that they could either try to grow this through large corporate M&A, or they could grow it through strong relationships where there is a cultural fit. And the latter is, of course, also reduces the risk of doing M&A and all the cultural aspects that could bring. So I can't answer specifically for that question of why they didn't do anything in the real assets larger, but I know that their ambitions are larger. Their ambitions in real assets are sizable. We have our own organic growth ambitions. We think we can do a lot ourselves, and we didn't particularly want to complicate the message to both our shareholders, but also the ambitions we have for our existing team by getting into anything that may distract them at this point in time. We have quite a sizable distribution team for our real assets, which has grown over the last 18 months, led by a lady that we brought in from Aberdeen from Fidelity, called Heather Fleming. So we've got quite decent ambitions in that space ourselves.
Okay, cool. Okay, fair enough. And just sticking with SEC for a minute, actually, we should probably mention there is a note out that we've written on Strategic Equity Capital this week, so I recommend that to you. Question here is, Tony, do you think you're going to get back involved in managing the SEC portfolio as you used to do?
So the strategic public equity way of doing things is very much a team approach. You do have a couple of names on the tin typically, as you either have to go day to day out to market to talk to investors, or indeed speak to other stakeholders. So if you have a look at GHS, I chair the investment committee. I'm one of the two named fund managers, have been since its launch. SEC is intended to retain Jeff and Adam as the managers, and that will be the case. And so that transition we're aiming to make as seamless as possible. The only difference will be that the investment committee they will be reporting into and making the ultimate decisions on some large investments will be chaired by myself. So to answer the question specifically is, yes, I'll be taking a role. I'll be chairing the investment committee that the two guys who are coming across will be reporting to.
Cool. Okay, fair enough. And again for you, I think. So do you think there needs to be any more incentive that the government needs to put in place to encourage the development of battery storage facilities?
That's an interest. That's been asked for a while. I think there's clearly some the business model of energy storage hasn't been completely formed yet. There are a number of ways of generating revenue. So there's contracted revenues, capacity market. I won't go into detailed contracted revenues that come in, but there's also those trading revenues I mentioned, so which are not contracted. There is development risks and execution risk at developing batteries. But so all of this is historically not involved any government subsidies beyond, well, certainly not in development stage. So if at the moment there is beginning to be a sense that the requirement for batteries is needed even quicker and greater than there has over the last couple of years expectations. So if that is concluded, then there will need to be some incentives. But there are increasingly some batteries being deployed. There are two listed investment trusts that do that in the UK. There's the Gresham House Energy Storage Fund and Gore Street. And there are increasingly some other participants now deploying in batteries and developing. So at the moment, there's, particularly given where the government needs to focus its resources, I wouldn't see there being a requirement, because there's already private capital going into this space.
Do you think you might tie up with any of the listed solar or wind funds and to put battery storage facilities into their portfolios?
So the co-location is very much on the agenda. Hasn't really happened properly or fully yet, but it is something that one should expect to happen in the short, medium term, definitely.
Cool. Okay. Good. Let's have a look. Anything else? That's all I've got for the minute. I'll give you just a couple of seconds to if there's anything else. There's one. I don't know if Tony will answer this, but do you expect Aberdeen to take a bigger stake in Gresham House in the future?
So part of our Gresham House's modus operandi is to have strategic partnerships in our shareholder base. So if you have a look at our shareholder base, we have our largest shareholder is one of the large pension schemes in the UK, local government pension schemes, who have been a big supporter in our infrastructure and housing area. Living Bridge, the private equity partnership, has decent shareholding as a result of working with us on our venture capital, private BCTs and private equity area. And Aberdeen, as part of their JV with us, wanted to take a stake, and they did so. There's no discussions for any larger stake from Aberdeen. at all at this stage. And I think it's working well. They're pleased that the investment they've made is my understanding, and they've made some money out of it already. So I think in a good way, we're in a good position at the moment.
Cool. Okay. Well, on that note, I think that's the lot. So thanks very much for that. Really helpful. Hope everybody else found it interesting. And I'll be back again next week. Thanks very much, Tony. Cheers.
Thanks, James. All the best, everyone. Stay well.
Bye.